In my videos, When Gold and Silver Go into Hiding and the Gold Must Flow, I introduced the system by which the petrodollar maintains support from the oil exporting nations. If you haven't already watched these videos, it will be instructive for you to watch them now before proceeding. If you have watched them, let's go over the mechanism briefly for a quick refresher. In the lower right-hand portion of this picture, we have the mechanism by which gold mines are funded. Mines generally need cash to fund new projects and even support current operations. They obtain loans of cash from bullion banks. The bullion banks require that the bank hedge the price of future production to guarantee a paper profit. This creates a commercial short position on future gold supply. Gold is delivered against this short contract. The mining executives are more than happy with this arrangement because, after all, they are paid to generate currency profits. So hedging their future price risk is their way of assuring themselves of future currency profits. Another piece of the puzzle is shown on the lower left. Here we see the practice of gold loans and leases. The bullion banks deal in both currency as well as in gold. They need to be able to mobilize gold when there are shortages, and so they obtain current gold from both monetary authorities as well as from some very wealthy interests who own gold. What do these gold owners get in return? Well, they get a promise of the return of their gold at some future date. They also get currency for that period of time, which they can deploy in the interest rate market to generate an income. Thus, so long as they are confident that they can get their gold back, this becomes a way of generating income from gold. Who says gold doesn't pay interest? It certainly does if you're well connected. And here's the key. All of the actors at the bottom of this picture create a covered futures contract for gold. When you think about it deeply enough, this becomes a gold-backed currency. It is essentially the same as what the dollar used to be prior to the collapse of the Bretton Woods system. And why is this gold-backed currency important? Because it's the gold that powerful oil nations want, especially Saudi Arabia. OPEC learned the hard way what happens when oil money bids directly for gold in the late 1970s. The price ran away from them, and the supply of gold dried up. This new system works much better for them because it allows them to trade petrodollar profits for this gold-backed currency. This guarantees them their gold, albeit at a future date, in return for the supply of oil now. Thus, this is what incents the oil-producing nations to continue to accept dollars for their oil, and the oil will continue to flow without the threat of military action so long as two conditions hold. First, the gold must be kept strong in dollars. In other words, the dollar must be able to purchase sufficient amounts of this future gold. And second, there has to be confidence that the future supply of gold will be guaranteed. These are no simple tasks. It explains why the central bankers are so interested in trying to suppress the gold price. That is what they need to keep the dollar strong in gold. It also explains why the central banks have leased their gold to the extent that they have. Now bear in mind, the central bankers would prefer to use other people's gold to back these contracts, and they were able to do so up until the late 1990s. The truly rich of the world, up until that time, had put enough gold out on loan to ensure that the future supply of freshly mined gold would go to the right people. Then some powerful Asian interests became aware of the suppressed price levels of gold, and they started buying up futures contracts, essentially cornering the future supply of gold. So since that time, the central bankers have been supplying their own gold to this market to back the contracts. This has much of the central bank gold pretty much tied up. But not all of the world's gold is tied up in these contracts. There are about 5 billion ounces of gold in hoards around the world. Sometimes this gold can be brought out of hiding in search of income. But there has to be incentive. And so, let's go back and talk about this incentive. Here I'm showing the 1-month GOFO rate, courtesy of the LBMA. This is the difference between the futures price of gold 1 month out and spot. One can view it as the cost of mobilizing gold. A gold holder will sell gold at spot for current cash and then buy a futures contract, generally on leverage, 1 month in the future. The difference between the spot and the future is what the owner of the gold pays to the bullion bank for facilitating the operation. The gold owner can then take the currency and invest it in the interest market to earn a paper profit. So long as interest rates are sufficiently above the GOFO, the owner of the gold will earn an income. And so long as the gold holder trusts that he will get his gold back, this is a smart thing to do. But what happens when the gold holder loses trust that the gold will be returned? Well, in this case, there will be no gold bidding for paper profits, and the GOFO will go negative, essentially paying the gold holder to mobilize his gold. This creates a risk-free profit. We can see one prominent instance of this in late 1999. There was a very large negative spike that signified the loss of confidence in the paper gold market, and gold went into hiding. We know the significance of this event from the statement made by Bank of England official Sir Eddie George. He said, "We looked into the abyss if the gold price rose further. A further rise would have taken down one or several trading houses, which might have taken down all the rest in their wake. Therefore, at any price, at any cost, the central banks had to quell the gold price, manage it. It was very difficult to get the gold price under control, but we have now succeeded. The US Fed was very active in getting the gold price down, and so was the UK. And we also know about later statements made by Chairman Alan Greenspan, stating that the US stood ready to lease gold in unlimited amounts should the price rise." So negative GOFO rates should be taken very seriously because it means that the petrodollar arrangement is losing its gold backing because gold is not bidding for paper profits. Trust is being lost. And we can see on the right-hand side of this graph that the GOFO rates now, at least at 1 month, are essentially zero. Gold holders can now mobilize their gold for paper profit at virtually no cost. But why haven't they been pursuing paper profits now? Well, it can be of one of two reasons. Either they have lost faith that the gold will be returned, or the currently low interest rates are not very interesting to them. But either way, it really doesn't matter. The paper system is losing its gold support. This is threatening the support of the oil nations for the petrodollar, and could threaten the flow of oil itself. But let's look at longer-term GOFOs and not limit ourselves to 1 month. We can see similar behavior in the 6-month GOFO. For months, it too has been pegged at zero. It's only when we get out to 12 months that we can see that gold lenders are showing an interest in lending gold for paper profit. The GOFO rates are marginally above zero, but large enough to serve as evidence that there is an interest in bidding for 1-year interest rates. But notice the ominous downward trend. It will not be long before even 1-year rates are not enough to entice gold out of hiding. When the GOFO goes to zero and stays there, it means that gold support for the paper currency is gone.